If you think investing is hard, then this is the perfect video for you. We're going to be laying out what Warren Buffett thinks is the best way to get started in the market. He originally gave this advice in 1999, but it still applies today. We're going to be discussing the article that brought it up and breaking down the well-defined plan that he thinks can help compound your money over the long run. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, I'd like to ask you a huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. With all of the intro, let's dive right into the nitty gritty. And this is the CNBC article that kind of spurred my train of thought here. And I completely agree. This guy is a mentor to me, somebody that I've learned a lot in terms of my investing journey so far. And in 1999, Warren Buffett was asked what you should do to get rich. As his advice still applies today. So the first piece is to start early. I started building this little snowball at the top of a very long hill. The trick to have a very long hill is either starting very young or living to be very old. I think that's the most important part, is to start. I think in platforms like QUESTRADE, I'm not sure about others, you can start for as little as $2,000. I know it might seem like a lot to a lot of people, but with the inflation rate that it's at today, I think it was like 5% that came out in the US. In Canada, it's around 3 to 4%. Well, if you're having your money sitting in a savings account, that percentage is deteriorating. And we're going to touch on that a little bit later. But what the Oracle of Omaha said is that if he was graduating from college in 99 and had $10,000 to invest, he would be strategic about choosing where to put his money. I would probably focus on smaller companies, because I would be working with smaller sums and there would be some chance that something is overlooked in that arena. So he said he would start by looking alphabetically in a list of all the companies that trade. And that can definitely still be done to this day in terms of how much time you want to invest and how much enjoyment you actually have looking through balance sheets, looking through 10Ks. And if you don't know what that is, that's completely fine, because he does have another strategy that is essentially foolproof if you factor in time. So it can't be just like 1 or 2 years you expect to become rich, become a millionaire. This is a process that takes time. And with a well-defined plan and well-defined strategy, you could be, wealthier than you are today. And that's pretty simple. And I think that's where you need to look at the S&P 500. And what Warren mentions here is that consistently buy an S&P 500 low-cost index fund and keep buying it through thick and thin, especially through the thin. So if you start to see, the S&P, if you're not familiar with what that is, that's the top 500 companies in the US. So it's a well-diversified fund. If you're in Canada, you can look at FV.to, that's a Vanguard program. It has a very low expense ratio. It comes with like a 1 to 2% dividend yield. That's what all these companies pay collectively as a group. So it's a very good fund to start in. There's also SPY in the US if you're looking at that. And when you're buying through platforms like QuestTrade, you don't pay any commission when you're buying an ETF. So you don't pay any commission. So you can sit there and say, hey, every Monday of every month, I'm going to be buying X amount of shares of VFV. And you're going to go in and say $200 worth, or I'm going to buy 5 shares, or I'm going to do whatever your defined plan is. Obviously, you have to have $2,000 to start up. And then maybe you might have some alternative plans in there saying, hey, if the S&P 500, the index is down 2%, I'm going to buy an additional X amount, whatever that amount is, whatever you have on the side. And we're going to be discussing a little bit about what the annualized returns are. We're going to be looking at the compound annual growth rate. If you're not familiar with that, the definition of the compound annual growth rate is the hypothetical constant interest rate that would be required for a compound interest to turn a given present value into a given future value in a given amount of time. So to make this very simple, it's the percentage amount that it's increasing year over year, depending on how many years you're invested. So the benchmark and what a lot of these financial advisors do is they look at the S&P 500 as the amount. So a financial advisor will sit down and say, hey, my goal is to, beat the S&P 500. Well, let's not try and beat it. Let's just pick a fund that matches what that return is, come up with a plan, say, hey, I'm going to put $200 in every week. And then essentially you're getting the same return and you're not paying a financial advisor to do it. And to put this into further context, let's take a look at what the compound annual growth rate is for the S&P 500. It does date back here to 1871. We're going to include dividends, and let's take a look at this metric up to year end, December 31st, 2020. We're going to say $1 grew to, and we're going to hit calculate. So my average return is 10%. 10%. And then if you look at the annualized return, you're looking at 9.25%. So if you hold this for a very, very long time, you're looking at about 9% return, which is fantastic. I know a lot of different people that can't beat these returns. Even if you try individual stock picking, a lot of people can't do it. So if you're looking for the easy and seamless way, why not just own the index directly through an ETF and focusing on something with a low MER or expense ratio? Obviously, 1871 was a long time ago, but if we were to look at something like a 20-year return on the S&P, you're looking at 6.59%. So still, 6.59% every year is better than the inflation, which normally trends around 1 to 3%. Now we're starting to see inflation trend a little bit higher. And that's why investing is so important, because if it is sitting outside of assets, outside of real estate, outside of stocks, if it's just sitting in your banking account, then your money is deteriorating day by day. So this is a strategy that I would definitely suggest to anybody that has, $10,000. They're looking for something that's easy. They can sit down and say, hey, this is my goal, 500 every month, 200 every Monday, whatever that is. Find a plan, find what suits your needs best, and just continue to buy this fund. It's well diversified, 500 different companies. I think it's definitely the smart way to play it. Definitely do some homework on it. I know there's a lot of context. Warren Buffett speaks about this a lot. This is where his money is going to after he passes away. For his wife, I think 90% in the S&P 500 ETF, and then 10% into, I think it's a 10-year bond or something like that. But 10-year bonds aren't playing a lot. But obviously, time reduces a lot of risk. So I hope you enjoyed the video. If you're still with me, you enjoyed it, you got some value, hit that like button for me. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on.